Hey guys, this is Kevin Wood with Stagecoach Equity and Management. Today we wanted to talk about numbers because at the end of the day, your properties always come down to numbers. What are the types of returns that you expect versus what you're getting? That's going to increase your property value. It's going to give you a higher return on your investment. So what we wanted to do is just give you guys a breakdown of what we look for in terms of our expense targets, our revenue targets, and make sure that you're doing the things necessary to kind of maximize the value on your property and also identify areas that are in need of a little bit of improvement. Revenue. It's not just one line. It shouldn't just be one line, particularly for apartment complexes. There are a few things that you want to look for. So the first is going to be, what are your market rents? Your market rents are going to determine the maximum value that you could be making on the property. And most owners will put that because when you're looking to sell the property or when you're showing it to banks, etc., you want to have that top line revenue be as high as possible. And we'll go over how to find comps in a different video, but just know that you need a top line called market rents. That's going to identify the maximum return for every single unit within your complex. From that, we want to subtract our loss to lease. So what the loss to lease is if a unit, let's say, was renting for $750, but the market rents at $800, my loss to lease for that property is going to be $50. And that $50 will show up as a negative line item in that loss to lease line above the market rents. And we do that for every single unit when we're preparing our financials. From that loss to lease, we're gonna get this kind of net rental number, and we'll have a separate line item below that that's going to show vacancy. So we have our market rents, we subtracted our loss to lease, and then we're gonna subtract vacancies, which typically you wanna target a 5 to 7% vacancy rate. A way to determine this is looking at historical data, and as well, typically the larger complexes, so we manage up to 250 units. Typically once you start pushing 100 plus units, that vacancy number tends to come down to 5% or so. The next thing that you subtract out of that gross rental number is we're going to subtract out concessions. So concessions would be something like $150 off the first month's rent, or free cable, anything like that actually deducts from that rental number because you're paying something on the back end or you're foregoing some of that revenue. All of that gets subtracted out in that concessions line, and that's going to give you your net revenue. I'm going to go through the expenses and then we'll talk a little bit about the targets to look for. So the first line item would be utilities. Utilities very often are paid for by the tenants if they're individually metered, or like in the case for a lot of our properties, you may actually be involved in a RUBS model. RUBS stands for ratio utility billing, and what that is we're going to take in the bills as the property manager. We're then going to allocate it by unit based on number of occupants or square footage. Once we have the utility bill calculated by individual, we then add that to their tenant ledger, and then they pay us back for that. So utilities can either be an income line above for RUBS, or if you're collecting some sort of fee, or you can subtract it out of the net expense. I personally like subtracting it out of the net expense, so that way it shows up as kind of one clean line there, and I can see what my actual utility burden is. But that's a personal preference. The next thing is going to be property insurance. Every property that is financed typically is going to have insurance requirements. We work with insurance brokers kind of around the country to get the best rate for ourselves as well as our other owners that we manage for. Typically, insurance is going to be a fixed price, and then there's going to be additional costs related to, say, flood insurance, which is very big in the Texas, Houston area, There could also be some other type of insurance because it's deemed to be higher risk. You want to get as many quotes as possible and get quotes from around the country, because maybe you talk to someone locally and they, risk your property a little differently than someone, say, a couple states over. So definitely want to shop that, because insurance is one of the largest expenses that you'll have per year for your property. The next fee would be kind of for you syndicators is if you are managing on behalf of other owners, there's often an asset management fee assessed on the property. Typically that's about 1% of total revenue collected. That line item should be in there specifically for your investors when you're underwriting a deal, to ensure that they're aware of it and that it reflects the performance of the property. Next, we have payroll and benefits. So payroll and benefits, this is going to be for your staff. What we recommend is once you start getting above about 80 doors, you want to have full-time staff on site. There tends to be enough tenant issues that happen that warrant someone being on site every day. That said, as well, when you're operating at a lower number of units, you don't necessarily want on-site management, because the property can't fully support that payroll burden. So as of 2020 today, typically an office staff person is going to range from between $30,000 to $45,000 a year, depending on their experience level. In addition, those people need to be managed. So typically there's going to be a property management fee on top of that for managing the employees. So what we do with our smaller complexes is we'll actually have part-time staff that will staff the office during high traffic times, and then just charge a nominal maintenance fee as well. And then we'll take our calls at our main office for that apartment complex and digitally schedule showings to ensure that there's always someone available to show. And it saves owners typically 25 to 50% off what they would pay a full-time person. So contract services, this is going to be for landscaping, for pool cleaning, the types of amenities that you wouldn't necessarily have in-house. For us, we typically will have a maintenance team, and similar to our payroll expenses, we'll have maintenance expenses as well. And these maintenance expenses include not just materials, but also maintenance salary. In some cases, the maintenance guys can do minimal pool cleaning, but sometimes if it's a larger pool or if it requires a lot of chemicals to be added and things like that, then we'll hire that through a third party. And landscaping is almost always going to happen with a third party, because landscapers can quickly landscapers have really high-tech equipment, so they can quickly come in and do the job much faster than your maintenance staff, and so typically it's a little bit cheaper than having your maintenance team do landscaping. So the next fee is general and administrative. This is kind of a catch-all fee, but it includes things like technology fees. So typically you're going to have some sort of software subscription related to your property. It includes things like if your office provides drinks. It includes things like if you need office furniture, if something breaks. All of those activities are covered in this general and administrative expense line item. Last but not least, and probably certainly my favorite expense, is property management. So property management is going to typically range from between 4 and 6%. And that depends on the size of the complex. The larger the complex, the lower that property management fee is. And that simply covers the property management team for the activities that they do. So as an example, something our company does for all of our owners is we do Kpis. We provide them financial information. We make decisions around leasing, decisions around pricing. And all of these things are communicated with the owner, but it's taken care of by us, so the owner can go and find that next property. And once you buy something, buying it right is probably the most important thing that you do. But immediately after that is, are you maximizing the return on investment for your property? And it's not about squeezing every last dollar out of every single tenant. It's really about having that balance of creating community and maximizing revenue, because over the long term, our view is that that's going to lead to higher asset valuation. If you slowly start scaring people kind of away from your property, you're not going to see that appreciation that you would if you're a welcoming complex that people enjoy living at. And so some of our complexes, we have people that have been there 3, 5, 10 years, and that's a function of the things that we do to kind of make that experience great for the tenants staying in our complexes. So the next one is you can't escape taxes, and property taxes are really big here in Texas. I know some other states have lower property tax rates. In Texas, that's one of the primary sources of income. And so typically, based on the appraised value of a property, which is somewhere between 60 and 80% of fair market value usually, you're going to pay taxes somewhere between 2 and 2.5%. So when you are looking at an apartment complex that's worth 10, 12, $14 million, that property tax number is very high. It's in the high 6 figures. And so it's very important that you get that number accurate. You can find that on your tax appraisal district. Expense that we were going to go over is advertising. So for your apartment complex, so the MLS requires that any units over 12 not be listed on our MLS. And so we will use free networks such as the Zillow network, as well as advertising channels such as apartments.com, where you can pay a fee depending on what the demand is for the unit and what our price point is. And so what we'll do is kind of do an analysis of what's best for our owners, what we feel like folks are using in and around the area, and then we will go ahead and use those same advertising channels as well as kind of some of the ones that we personally like. That is not every single expense that your apartment's going to have, but we just wanted to give you guys an intro of some of the things you should be thinking about as an owner and making sure that you're on top of all these numbers, because if any one of them starts going crazy on you, then you can really start to lose value on your property. And we don't want that. We want you to be able to refinance for as much as possible, for the property to appreciate as much as possible, and you to get the best return on your property as possible. Finally, the last bit, I wanted to go over some of the range of cost per door. This is numbers used during underwriting, but I wanted to just pass this on to you to kind of give you an idea. So again, we talked about management fees. Management fees are going to run between 4 and 8%, depending on the size of the complex. Typically, if it's 50 units or more, you're going to be somewhere between 4, 5, maybe 6% if it is a property that requires a lot of additional management. Advertising is typically going to run you about $25 to $70 per unit. Contract services, $150 to $200 a unit annually. General and administrative is $50 per unit annually. If you do throw some additional things in there, like you have an office and things like that, you can get up to 100 to 300 units annually. Also, if you do a lot of community events, that can also push that number up as well. Insurance, it depends entirely on your market, but it could be anywhere from $275 to $400 a unit annually. Repairs and maintenance, that's going to run you about $400 to $500 per unit annually. Taxes are going to vary by state and county. Look at your appraisal district. Our property taxes are between 2 and 2.6% for most of the properties that we manage. Turnover, typically they say about $250 per unit annually. Turnover being when someone moves out of your complex, you need to do some light maintenance usually and some repairs in order to get the unit ready for the next tenant. For utilities, electricity is going to run you between $75 and $150 per unit annually. That is going to vary based on if you're billing back utilities or if the tenants are paying utilities themselves versus all bills paid, utilities included. You also have gas and water. Some complexes don't have gas, but if you do have gas, then you can expect to be paying $35 to $50 per unit annually for that service. Trash is a big one as well. For a larger complex, you're going to need to pay a trash company to come and haul your trash. That will typically range between $125 and $200 a unit annually, depending on the size of the complex. Water and sewer is going to be between $470 and $750 a unit if the landlord pays. And again, I highly recommend looking into the RUBS billing system if you're not doing an all bills paid model. And for us, we found RUBS with a lower rent to work better than all bills paid. And what we end up doing is the last one I was going to review in terms of cost per door annually is water and sewer. We RUBS that back. I highly recommend that you do that if you're an owner. It dramatically lowers the cost of maintaining the property. And in our experience, it's easier to fill RUBS units at a lower rent than it is to charge a flat rent for all bills paid. The one exception I would say is if you are dealing with very low income folks, if they are individually metered, they may not have the credit score or the ability to pay for their utilities without a very large deposit. And so for those type of tenant bases, we typically will look at an all bills paid model more so than some of our other complexes. That's it. That's a brief rundown of the revenue and expenses that we look at from this, and we'll look at it in another video. We develop KPIs, which are our key performance indicators. What we'll do is we'll look at the variance in these different accounts as time goes on. And if we see one of the line items, either an expense getting too high or revenue coming down, we'll dig a little deeper, figure out what's going on, and then triage it. But as you know, if you're buying apartments, you have to know your numbers, and it's important that you are focused on the return on your property. If you're interested in property management services, we manage complexes from 5 units up to 250 units. We primarily service in and around Texas, in the Houston area in particular, and we look forward to hearing from you. Let us know if we can help. We'll see you next time. Thanks.